Hello everyone, today on Options Made Simple, we're going to talk about incorporating options into your portfolio to not only maximize your profits, but also get you the best possible cost basis for your shares. This is done by selling options that are known as covered calls and cash secured puts, which is a way to sell options while still having defined risk. A covered call is when you sell a call option against shares that you already own, and a cash secured put is when you sell a put option against a company whose shares you don't own but wouldn't mind owning. So keep in mind when you're selling options, whether you're selling a call or selling a put, you're receiving premium in return for the option contract that you're selling. Please make a quick note moving forward that everything we discuss revolves around buying or selling 100 shares of stock. So everything we discuss will be in multiples of 100. Okay, so we'll start with covered calls. Remember, when you're buying a call, this means you have the right to buy 100 shares at the contract strike price on a set date. But when you're selling calls, this means you have the obligation to sell 100 shares of stock at a predetermined price, known as a strike price, on a set date. So what that means is that if you own 100 shares of stock, then you can sell a call against those shares, and that would just be an agreement that, all right, I'll sell you my 100 shares of stock at this price by this date. You have defined risk because you already own the 100 shares of stock to give to the buyer if the contract were to get exercised. Even if it went way past your strike price, you do not have to go and buy more shares on the market because you already own the 100 shares. You can sell one call contract against each 100 shares that you own. So if you own 352 shares, then you can sell up to 3 call contracts and they would all be covered by the shares that you already own, hence why it's called a covered call. We'll use Palantir for our first example. We'll say that you owned 100 shares of Palantir and that Palantir was currently trading at $26 per share. So we'll say that you sold one call contract with a $30 strike price for a premium of $3 that expires in 30 days. So what this means is that if Palantir is trading at $30 or higher on the contract's expiration date, then you have to sell your 100 shares of Palantir to the buyer of the contract for $30 per share. But if by the contract's expiration date, Palantir is less than $30 per share, that means that the contract will expire worthless and you get to keep your 100 shares of Palantir, and you also keep the premium that the buyer of the contract paid you for the call option. Now let's do the math on this because it goes a little bit deeper. Since you received $300 in premium for that call contract, you would actually be selling the shares at $33 per share if the contract was exercised. You would find the cost basis that you're selling the shares at by adding the premium you received to the contract strike price. I'll include the full equation on the right side of the slide for those of you who want the more mathematical explanation to this. Another thing to keep in mind is that if that call you sold expires worthless and you get to keep all the premium, then you just lowered your average cost basis for those 100 shares of Palantir. So if your average cost basis was $22.70 for those 100 shares, you would subtract the premium and that would bring your new cost basis down to $19.70 per share. So when's the best time to sell a covered call? Well, this is one of those things where you can ask 100 different idiots and get 100 different answers. But personally, I think there's 2 optimal scenarios for selling covered calls. The first one would be when implied volatility is high. So this can be when there's like an upcoming earnings report or really exciting news just got released for that company and everyone's going crazy buying call options for the stock. And the second scenario would be when the stock is trading well above what you bought it at and you think that it's hit a temporary top. Because if you're right and you sell the call when it is at a temporary top, as the stock goes down, it's going to offset your losses because the call will gain value as your shares lose value. And if you're wrong and the stock keeps going up, then, at least you're selling it for above what you paid for it. You're probably making even more profit because if you just would have sold the shares at the current price for when you thought it was the top, then you would have just got paid that price. But when you sell a covered call, this adds on to the cost basis that you're selling the shares at, so you're actually getting more bang for your buck. The drawback of a covered call is that it caps your potential profit because if the share price really blows past your strike price, there's not really much you can do. I mean, you can roll it out to the next month, but then the trade just tends to drag on for a while. Usually, I'll just let the shares get assigned away to the buyer of the call contract if this happens to me. Okay, now let's talk about cash covered puts. A cash covered put is when you have the funds available in your account to buy the 100 shares of stock if that put you sold was exercised. Cash covered puts are great because they allow you to lower the cost basis on shares that you wanted to buy, or if a stock is trading at a price that is higher than what you're currently willing to pay, it will allow you to either still profit from that stock if it keeps going up, or let you buy shares at the price that you're willing to pay for it if the price comes down. We'll use GM for our example. So GM is trading at about $58 per share at the moment, and let's say that was too high for you and you felt more comfortable paying about $55 per share for GM. So you can sell one put with a strike price of $55 and the expiration date would truly be up to you. In order to sell this put, you would have to have $5,500 available in your account to buy the 100 shares of GM if the put was exercised. Let's say that you collected $450 in premium for this put. So what this means that if GM stays above $55, then the contract that you sold will expire worthless and you keep the $450 of premium. But if it goes below $55 per share, then the contract will be exercised and you would have to buy 100 shares at $55 per share. So if you do the math on this, you'll find that your average cost basis was actually less than $55 per share. This is because you collected $4.50 in premium, so you would subtract the $4.50 from your $55 strike price, and your average cost per share would be $50.50. The best time to sell a cash secured put truly depends on what your overall goal is for selling the put. Generally, a good rule of thumb when selling contracts, whether it's calls or puts, you want to sell the contract when implied volatility is high and you believe that the option is overpriced. But with a put, if your goal is to get assigned the shares of stock, then you would just sell the put at the strike price that you're comfortable paying for the shares, and that's really all there is to it. But if this is a bullish play for you and you don't necessarily want to be assigned the shares, you just want to collect the premium, then I would wait for a dip in the stock price and hopefully that would be the low. And then you would go ahead, sell the put when you think it's at its lowest and hope that it just rebounded from there and stayed above your strike price. And that way you would just collect the premium and you would not be assigned the shares. So to figure out what your maximum loss would be on a cash secured put, you would have to figure out what your average cost basis would be that you're purchasing the shares at. That was the equation that we just did, and multiply that times 100. The reason why that would be your maximum loss is because if GM went down to $0 per share, you would still have to buy 100 shares for $55 per share, and you wouldn't be able to sell them because they would be trading for $0, but the premium that you collected, which would be $450, would offset your loss a little bit. So your maximum loss would be $5,050. The maximum profit for a cash secured put would be the premium that you collected. So in the case of GM, your maximum profit would be $450. So to end this section, I'll talk about an option strategy that option traders like to use that's called willing a stock. When you will a stock, you start by selling cash secured puts on the stock, and if that put you sold expires worthless, you collect the premium and then you sell another put. And you just keep doing that until the share price goes below your strike price and you get assigned on those puts. Once you get assigned and you have the 100 shares, then you start selling covered calls. Then you would sell covered calls repeatedly until those shares got called away. And basically, this is an option strategy that's used to just collect a lot of premium. It's best to do on stocks that you don't really mind owning. And as long as you don't over leverage yourself or do it on highly volatile stocks, it's a great way to collect premium and it's not too high risk. So to conclude, covered calls and cash secured puts are one way that you can incorporate options into your portfolio while still having defined risk and using them to enhance your profits or lower your cost basis for shares that you want to own. We'll see you next time on Options Made Simple.